Thanks for tuning into this earnings conversation. GMM Pfaudler reported a 13% YOY growth in standalone revenues. On a consolidated basis, it was a 21% uptick, net profit up 29%, and margins improved on a YOY basis. Tarak Patel joins in right now to talk about how the quarter went by and what the time ahead could look like. Tarak, good having you. Thanks for joining in. Put the quarter into perspective. When we first spoke, as I said in my last interview as well, when the COVID broke out, you mentioned that you would probably be least impacted by this. Is the second quarter also a testimony to that?
Yeah, so I did speak to you, Niraj, quite a few times. I did mention that we had a strong recovery in Q1. Even though we lost about 25 days in April, we really had a strong performance in Q1. Building on that, Q2 has been really strong for us. Very good momentum being picked up. We expect the last two quarters, Q3 and Q4, to also continue the very same momentum. So I do expect the next 6 months to be quite a bit better than this. We expect the margin profile to remain around the same that we currently have shown in Q2. So all in all, very confident on the business front. Order book remains very strong, and the industries that we cater to, chemical and pharma, also continue to invest. So quite a positive quarter for us.
Right now, since this entails not the global ops, but the ops that we've known thus far, how has been the customer response? I know the order book is not an issue for you, but surely orders coming in is never a problem. What has been the customer response for your end industries? Because they too, like yours, are largely unaffected.
Right. So, what we're seeing, Niraj, is a bit of a change. So maybe if you spoke to me maybe 2 or 3 quarters ago, I would still tell you that chemical is by far our most important industry segment. I think that's changing now a little bit. So in this quarter, we had pharma pick up quite significantly, accounted for nearly 40% of our total revenue. So pharma is seeing a lot of traction. I think this entire shift from China to India, creating local supply chain, finding alternatives to Chinese product, is picking up here. Companies are investing, and I think that's going to continue over time. We're also seeing some of the chemical companies actually kind of diversify and enter the pharmaceutical segment, so that's happening. Just one more point here is that even at a global level, our Swiss subsidiary Mavag currently has an order book of about 20 million Swiss francs. Never in their life have they had such a large order book. So what we're seeing is even pharma in Europe and US is picking up. So, these countries are now building redundancies. They kind of realize that they had too much dependency on India, China. And I think that is something that we will see over the next few months. People will invest in international geographies as well as they will in India.
So is this pickup from pharma or the more dependence or a higher contribution from pharma a factor of pharma doing well, or is it also a factor of chemicals taking a backseat because things might be slowing there? Just wanted a perspective.
Yeah, that's it. I'm not really sure. I think, the chemical is still also investing. So again, even in the chemical front, people are looking at alternatives to China. They had a significant, kind of investment there, but people are looking to, kind of move something to Indian shores, kind of diversify and not depend only on one supply chain. So chemicals is still very strong. We see our customers like PI and SRF continue to invest, but pharma is something that's shown a lot of traction, the emergence, if I could say so. And I think pharma will kind of over the next few quarters play out in a very positive manner.
Okay. Now, I presume that towards the end of quarter 2 or maybe in the month of October, you've commenced operations at the glass-line equipment facility in Hyderabad too, right? Which you acquired. So does that start showing up on the revenue scale immediately in quarter 3 itself? And how large a facility, what's the capacity utilization, and how does it contribute?
Sure. So we actually just notified the stock exchange yesterday that we actually started production. So we got the factory a couple of weeks ago. We actually went down, did the inauguration, and we started manufacturing a few days ago. The first equipment actually came out of the glass lining furnace this afternoon. So we are now in a position to start supplying. We expect about 30 crores of revenue coming from that Hyderabad facility for this financial year. So we have about 6 months left, and about 200 EUs is what we are planning. We have to ramp up the capacity there. We still haven't really brought in our own people and started working on operational excellence and reorganization. And once we start doing that, I think we will definitely see an improvement in throughput. But as of now, it's up and running. It's working quite nicely. And also from a standpoint, I mean, just going back on glass lining, this quarter will also now include our 2 new gas furnaces. So our gas furnaces from Japan have been installed, they have been decommissioned. So Q3 and Q4 will see some benefits of better margin profile because we are now switching from electric to gas. All our production here in Gujarat will now only come out of the gas furnaces.
So you're saving on the input cost. It's not a factor of you being able to charge high for...
No, it's basically yes. So electric furnaces are about twice the cost of gas. Gas is available in abundance in Gujarat. And what we've also seen in this quarter in Q2 is that gas prices have reduced. That's also given us a bit of an uptick in terms of margins. And now with everything moving to gas, I think we can continue with the same kind of margin profile or even look at improving slightly on that front.
Okay. And sorry, just to get those numbers straight, you mentioned 30 crores for the rest of the year, which means about 10% of your quarterly revenues will come in each quarter from this new facility, right? So that's about 15, 16 crores.
So just to give you an overall picture, so we are clear, we have a current capacity in Gujarat of about 2,300 units. In Hyderabad, we have a yearly capacity of about 400 units. So for 6 months, it will be about 200. And with these 2 new facilities coming in the first year, we can add about 200 and 250 units as well. So all in all, I think from a capacity standpoint, we are in a good position. We can go after market share. I think customers who were kind of not coming to us because of the long lead times will now definitely have an option and will come back to us because we can deliver much, much quicker.
Okay. Just 2 more questions, Tarak. One is, would these facilities be enough for you within the domestic operations to meet the increased demand? Because as you said, pharma is showing a big lease of life. So would you have to just take the capacity utilization up a notch? Or do you reckon that sooner rather than later, you might have to think of setting up additional capacity?
So I think we're okay for 12 to 18 months. If we see a big upsurge in demand, then, we can move very quickly. I think the next level of investment, if any, will come into Hyderabad because that's where we have land available. We can also reorganize the factory there. So there is some enhancement that is possible in the next 6 months, 12 months. But I think for the short term, we are in a good situation. I don't think that we would really need to add a lot more capacity unless something crazy happens to the market. But I think even if we do see a lot of investment, we'll be very quick. I think we will take a decision very quickly to add a couple of furnaces in Hyderabad. And then before you know it, we'll be up and running there as well.
Okay. So nothing that looks like spoiling the apple cart. If anything, as I look at my numbers for Q1 versus Q2, 154 crores, consolidated revenues, Q1, 186, Q2. If anything, the Hyderabad facility adds and the natural organic growth will only add. So you're looking at a much higher Q3 and Q4. Anything that could upset the apple cart?
So I don't think that COVID is going to play a spoil sport. I think most of the country is now back up and running. I think the recovery rates are quite high. Even at a local level in our factory, we are working at full capacity. Obviously, we are taking precautions. We're wearing masks. But, I don't see, like you said, anybody playing spoil sport. If anything, we're going to just pick up on the momentum. The Hyderabad facility is, just an extra, the addition that we will add, and from the margin profile that we are expecting, I think all in all this year will probably be a very significant year for us, both in terms of revenue and bottom line growth. And then obviously in Q4, then the international transaction kicks in. I mean, obviously there's been a lot of talk around that, but there is something that we really have to work hard. It's not easy. It's a lot of work to be done, but we are quite confident that we can turn those businesses around very, very quickly.
Yeah, I was just going to ask you that. So we'll have an expanded equity base and expanded revenue and bottom line because all the revenues get consolidated starting Q4. So would we see that at the end of Q4 FY21 that all of those would happen?
Yes, absolutely. So we expect the transaction to close sometime in the middle of December, 3rd week of December. January 1st is when we will start consolidating. So by the end of Q4, you will have the entire global operations flow into the GMM Pfaudler numbers. Okay.
Tarak, just one, just because everybody would want to kind of understand this, because the expectations are that from whatever 590, 600 odd crores that you did in FY20, once these console numbers come on stream, your revenue and your profile effectively changes dramatically, right? So you reckon that you could go up to what, 2,000 odd crores in the current year itself on the revenue front at the end of FY21? And what would the expanded share capital be? Just a hygiene question.
Yeah, so on the front of the revenues, the guidance that we have given on our investor presentation was about 2,000 crores and about 13% EBITDA margin. I think this 30% EBITDA margin might improve. I think the Indian operations is doing well, and that would obviously contribute to that. I think internationally also things are looking bright. I think that would see some improvement in EBITDA margin. In terms of share capital, I think that remains the same. There's no new shares being added in the market. We've just raised debt. The number of shares in the market remain the same. So earnings per share would increase.
Okay. Fair call. Tarak, congratulations on a very good quarter and all the best for the quarters ahead.
Look forward to speaking to you again, Niraj, and thanks so much for having me. Nice talking to you.
Likewise. Thank you so much and stay safe.
Take care.